So much for a sleepy August. After a rough start to the month and a particularly worrisome start to the week, we've seen investors roaring back into stocks over the last 24 hours. Let's bring in Brianne Gardner, Senior Wealth Manager with Velocity Investment Partners at Raymond James, to get her take on the markets. Brianne, it's always great to see you. What have you made of this week in the markets?
Yeah, John, thanks for having me on. We had, and I was on the show, I believe, with you talking about this earlier in July, and we had talked about, seasonally, the two first weeks in July are usually the strongest seasonally. Then we see a little bit of weaker in the second half of July, and August and September tend to be the two weakest months of the year. So for us, we were getting a little bit proactive in taking some profits off some of the stocks that have rallied up year to date and getting back in line with our models, knowing we were coming into seasonally a weaker period for the market. So for us, same thing. We think a little bit of the market volatility is a knee-jerk reaction. We did see stocks kind of after that recent short-term sell-off close higher yesterday. Still, S&P 500, NASDAQ, small caps, Russell, we're up about 1% by the close, seeing green again across the board for the indices. So for us, we did expect the volatility to pick up. But I would say we didn't expect kind of the knee-jerk reaction that we did see with this sell-off, especially after on the back of kind of seeing the S&P 500 actually hitting an all-time high 3 weeks ago in kind of mid-July. When everyone was more concerned about the quick drop that we saw in August.
Yeah, I mean, we're still only a few days removed from an all-time high for the TSX. So how are you going to be approaching investing from here on out?
Yeah, for us, I think, we try to ignore a lot of the noise is what I like to say. I do think it is important to keep a sight on bigger picture, right? We still see the economy is doing well. Granted, it is slowing and has slowed, but we still see the labor market is still adding jobs at a healthy pace, right? We saw a 4.3% unemployment rate is still historically low. Q2 GDP came in above expectations at 2.8%. And while Q3's GDP is forecasted to be lower, it's still at that 2.5. And corporate earnings and sales estimates are trending up with Q3 earnings growth estimated at that 5.5. So we do see opportunities in this market right now, and we still see this broadening out and rotation happening, which is great for investors who do have diversified portfolio, right? We saw tech selling off, the Magnificent Seven selling off. We use that as actually an opportunity to add to some of our positions in those names that we took profits on earlier. So a great active trade there. Same thing, consumer discretionary was down about 9%. We've been underweight that sector for a while in Canada. We saw tech, energy, materials, significant parts of the TSX kind of dragging the index down. But again, you also saw safer sectors like utilities, real estate were the most resilient. So we think that we're talking, constantly about sector rotation, biggest signals of this, and we think we're well diversified to take advantage of that. So we still think defensive stocks, even if you think of like Northwest, Dollarama, Capital Power, Hydro One, TELUS, Fortis, also all up this month. And those are a lot more rate sensitive sectors and stocks that we think still have opportunity to run on the back of interest rates coming down. So for us, risk management is critical to portfolio construction and downside protection. And we've seen investors lose a lot of years of profits and can happen on knee-jerk reaction. So rules-based investing is definitely our philosophy.
So based on what you're saying, I think a good example, at least of a stock story today, is Shopify. Because, again, I would say there's been a good number of pundits who have been cautious on tech. And obviously, tech has had some challenges recently. But all of a sudden, if these gains on the intraday basis hold for Shopify, you're talking about a stock moving 24% in one session. And as we know in the investing game, when you miss those best days, well, it shows up in your long-term performance. What do you make of the fact that companies like Shopify or even bigger technology companies that have growth ambitions and there's spending that's associated with that, but they can also pull these levers that can please investors in the short term. I mean, who holds the cards here? Is it the investors or these big technology companies?
Yeah, I think, you have to look at every stock. We do both fundamental and technical research when we're looking at, what sectors to shift the portfolio overweight and underweight, and then deeper dives into the actual fundamentals of that stock, right? Looking at management, looking at profitability, looking at earnings estimates. Obviously, the nice pop-up we saw in Shopify, we do own it in our higher risk model, and like to see this pop that we have seen, which is great. I think we saw revenue for the quarter ended June 30th was $2.05 billion, up from $1.69 billion a year earlier. And so I think that did exceed analyst expectations too, which is great. So we are seeing too, we saw their revenue is expected to continue to grow at, still that low to mid 20% rate. So, we're seeing analysts also looking at Shopify, starting to revisit, even with kind of how the stock has been down, to see a nice pop in a stock like this. We look at more than just fundamental. It's looking at value. It's looking at what the profitability, and sometimes it's also short-term tactical plays, right? Knowing like after you see something like this, continue to ride the momentum or take some profits off the table. So I think, seeing the results we saw from Shopify, they saw their second quarter earnings, 171 million. And I think it's a great, per share basis, Ontario-based company. And I think it's great to see that. So again, we own it, cloud-based. Have participated in that now, and I think there's still more upside in this stock.
Okay, so we talked Shopify. You mentioned some defensive-minded stocks that might continue to benefit if the rate environment changes. Any other stock ideas you have for our audience this morning?
Yeah, I mean, I think you were looking at the fear and greed index. You see the volatility. I know the classic Warren Buffett saying, be greedy when others are fearful and fearful when others are greedy. For us, we took this volatility as an opportunity. I like to always remind all of our clients and investors, normal market volatility, you see 3-4 single-digit corrections a year, 1 double-digit correction. So this is a great time for a pullback. And a great time to take advantage if you are underweight certain sectors that you want to be well positioned for the second half of the year. We believe in being more active, especially ahead of the U.S. election. Companies like Meta, along with healthcare stocks, Abbott, Procter & Gamble, Merck, AbbVie, Eli Lilly, have stayed positive, all stocks that we do own, and stocks that we do like. Amazon, we've actively traded Amazon multiple times through corrections, and it does work very well on a technical level. Looking at Google, JP Morgan, and Microsoft as well, pulling back, gave us a chance to really add back into those names again and getting them at May price levels. So again, when you look at where a stock goes, how much it increased, and if you can pull back and get it, a few months earlier at that price level and pick up or add to a position, that's when you really get the value over the long run.